Hi, Dominique, and welcome to another edition of the Week Ahead. Apologies for a slight delay. We were in the countryside, and then I was just watching the end of the Argentina versus Mexico, and which Messi scored, and it looks like Argentina's well, at least they're still in a chance, very good chance now, I guess, to move out of the initial round robin, I guess, for the tournament. So that was quite good, and happy for all our Argentinian friends. So how are you?
I'm looking forward to US, Iran.
Yes, it always seems like the US and Iran play each other at the World Cup. But so yeah, I mean, we watched my son's quite torn, obviously now living in the UK, but we were rooting for the US last night, I must say. So, okay, let's kind of dive in. I guess this past week, especially because of Thanksgiving and not that much data coming out, not that much big Fed speakers, but markets were fairly quiet. I don't know if you had any kind of big takeaways.
I was surprised by the minutes. It showed more divisions than I thought. And I'm wondering if Chair Powell is going to manage to get his committee members to pencil in the higher terminal rate for the Fed funds. Because remember, the way it works is that, so he has a fairly good control on the rates decision itself. But the terminal rate, it's basically a projection that each participant to the meeting, whether they vote or not, submits, prepares independently and submit when they get to the meeting. They have an opportunity to change the projection after the first day of discussions.
Yeah.
But I was surprised. I mean, it said various participants, and various is not, it doesn't, various participants were thinking of a higher terminal rate, that a higher terminal rate would be necessary. But, you know, the minutes have a series of codes, like a few participants, many, a majority, almost all, and various is not part of that vocabulary, and it's made me wonder if Chair Powell is struggling to find, enough members willing to hike the terminal rate in 2023. So, and if so, it shows that the divisions among FOMC members are already quite strong, which is quite extraordinary.
Yeah.
Because
it definitely seems like it's coming out. It's like, until I would say 4 weeks ago, it feels like pretty much everyone was on the same page. And now the Hawks and the Doves are kind of establishing their camp, like we've had, in years past. Like, I would say, you follow us way more than me, but I've been surprised by the real uniformity of views up till now, including, remember you were saying, like, people like Cook, but I feel like Brainard made this kind of debatable discussion, but maybe a month ago, where she said, well, we look at international factors and all this stuff. And basically since then, it's kind of like people are kind of getting in the two camps. But the market took it fairly dovish, was my understanding.
Oh, definitely.
Right or wrong,
So we have a speech. So the big event of there are really two things this week on the Fed. It's obviously the speech by Powell. And I expect him to be quite hawkish. Look at financial conditions. The Goldman Sachs Financial Condition Index is now below where it was in September. So we are at the same, based on that index, we are at the same level of financial conditions as we were when interest rates were 150 basis points lower, right, which in my view is a direct consequence of the Doves, talking about pause and making sure we are not over hiking. So that can't be, something that makes Powell happy. So I suspect he's going to be quite hawkish, and basically say that we need the labor market to be much weaker than
right.
It is.
One question, because and I feel like I always ask these questions of, for people who are not super technical in the weeds like you are. And my understanding is like there's maybe superficially there's this view that's been kind of building momentum the last 2 to 3 weeks. I wouldn't just say in the US, but probably in Europe as well, which is inflation is slowing, even though growth is not. And is it possible that, again, Italian confidence, German GDP, although in Europe, inflation doesn't really look like it's coming down. Maybe there was one or two things a bit softer for the first time in 6 months. Obviously, in the US, you've had kind of CPI, some questions, and obviously you have forward numbers coming up. And you have oil, which has come down quite a bit. But in general, there's a view, I can understand. I thought initially that bonds are rallying because the market's perception is that growth was falling off a cliff, finally. Especially if it's really kind of high frequency or kind of soft data, I guess, was really turning. In general, growth still looks pretty strong in the US and Europe. So the main question is, can you see inflation coming down without growth having a significant downturn from what we're seeing?
No, I don't. 3/4 of inflation is services. Services inflation is wages. I'm expecting quite a big catch up of wages at the end of the year because real wages have been falling and the labor market is super tight. I think the market is underestimating the strength of the labor market. I would say, and maybe this is a good way of summarizing what happened to the data last week. So every day we have hundreds, perhaps even thousands of pieces of information that can be used to predict inflation or growth. The key is to find a good way of aggregating this information, soft, hard, and so on and so forth. So what I like to do is to actually use nowcast, both for GDP and inflation. And so if you look at the Atlanta Fed GDP nowcast, which is one of the more reputable and publicly available ones, it shows that GDP, their estimate of GDP growth for this quarter was up 10 basis points on the week to 4.3%. So in terms of staying very close to the data, it's not telling us that growth is slowing. And same with inflation, by the way. The Cleveland Fed has an inflation nowcast, and they expect the CPI core month on month for November. Right now it's 51 basis points, unchanged on the previous week. So this is when you get very close to the data. Now it's very short-term view. To have a long-term view, you need a macro model. My macro model is super simple. We've discussed it many times, services, inflation, wages, unemployment. What can I say? I mean, I look at the data and I think the market's going to be once more surprised by the FPs.
Let me ask one other question then. And I know this is actually one of our key calls, which by the way seems to be working great. If growth is still fairly strong and the market is not correct there, and certainly inflation's not coming down, let's say it's the same, not even say it's exploding higher. Why is 2s, 10s inverting so much then? If growth was strong, shouldn't the whole curve be stable or even the long end should be going up, or is it so far out? There's other factors.
No, I think.
Or I guess the idea that the Fed is going to have to go higher,
exactly,
and eventually that will,
Exactly, because I think 10s are still rising. They're just rising by less than 2.
I mean, I'm just looking last week. They've come 10s have come down by 15 basis points in the US, and in the last 1 month, 30 basis points. I mean, obviously this was from yields are definitely coming down, even in the long end. I would say, we had a discussion over the summer when people said recession, and we were all in agreement, the market's totally missing this. And you kept saying this is a blip, if anything. The market's reaction now seems a bit different. I guess my understanding was people were seeing things like, I guess, individual company reports, retailers, things like this. We're going to know at least for like Thanksgiving or Black Friday or Cyber Monday quite soon.
But precisely, Andrew, if you look at company reports, there was an article in the Wall Street Journal talking about how S&P constituents are all gearing up for record capex this quarter.
Yeah.
Hey, it's not it's not a slowing economy. I don't know. Perhaps people are paying too much attention to tech. What I think is happening with tech is that now they have to deal with higher yields, capital markets that are no longer prepared to subsidize them.
And they fundamentally hired just way too many people the last 2 years.
Well, there is that. But again, I mean, if you look at labor, the growth in employment in this country, it's still about between 3.5% to 4%.
Right.
So tech gets a lot of media attention.
Right, but it's
good. But in terms of their share of the economy, it's a very productive industry. So the share is very small.
I was also going to say the FT I was reading on Friday. I think it was FT was talking about what you were talking about a few weeks ago, that this part of your thing talking about the semiconductor ban or the I guess the high performance semiconductor ban to China is going to end up being a very big inflationary impact over time. And I think that makes a lot of sense. I think that was your core point. And then you had a point also, just even that complexity is slowing,
But that's more long term. I mean, in the short term, if you can show me data that will tell me the US economy is slowing below trend, because my view initially was that it would slow to trend, but now, looking at NFP, looking at household savings rate, looking at what's likely to be fiscal policy, and also just looking at the data, look at the nowcast, I think it's not slowing to trend anymore. I think it's rebounding. And as always, I could be wrong, but I'm not going to change my view because the market is moving my way. I'm going to change my view when I will find strong data.
Right. Okay. So where last week was fairly quiet from a U.S. standpoint, this week a lot more potential, let's call it fireworks or data points. A lot more information is coming. One, you said, is Chair Powell speaking. Where is he speaking? What and your point is that he's going to reinforce a hawkish view because of how much financial conditions have been loosening in the last couple of weeks.
Yeah, it's quite a solemn speech. He's speaking at the Brookings Institution, which is a premier macro think tank in the US. And it's quite a big speech, the labor market, the prospects for growth, and so on and so forth. I pity Chair Powell in a way, because when he talked about transitory inflation a year ago, he was just repeating what his staff had told him, because the Fed has
100 PhDs. Yeah, exactly.
The 400 PhDs that as long as inflation expectations are stable, the supply-induced inflation is self-correcting. So he believes that, and that's why he went out. And by the way, this was a speech, a 2015 speech by Yellen. So he just repeated what the highly respected Yellen had said. And I think now he's learned, one, not to trust his staff and to make up his own view. And I think his own view is quite on the hawkish side. So we shall see, but I think he's much more data-driven and much less model-driven. And if he's data-driven, he should be fairly hawkish.
Fairly hawkish. And I see, again, a big slate, if I'm reading this right: Williams, Bullard, Bowman, Cook, Dobek, Logan, Barr, Evans. They're all speaking?
Yeah, this is the last week. This is the last week before the pre-meeting blackout. And I guess they all want to stake their territory. And so, yeah. But it will be interesting, again, I mean, it will be interesting to see what happens to these terminal Fed funds and how much of a dispersion we are going to have.
Right.
Because the Fed has a tradition of a consensus that no one really challenges the boss, it's bad form. And it will be interesting to see if it is different this time around. Shall we talk about the data?
Yeah, no, I'm just looking. So right now, the market's pricing basically a peak of around 5% in May of next year. Yeah. Yeah, very busy week, it looks like. What are the most important things, data points that you're looking for, and are you expecting at a consensus print on any of them?
So on the NFP, absolutely. I mean, I'm surprised that the market is so pessimistic. I think we could have quite a big surprise. And by the way, I mean, the core of my macro view is the resiliency of the labor market and the decline in the household savings rate. And it's no magic. There's no magic here.
Yes,
The US
yeah.
is 70% consumption. You know, the US consumer is like the Energizer bunny, it never stops. So
to be fair, a strong labor market's kind of been like a bizarre global phenomenon as well. And uniquely in the US, but like if you look at unemployment rate in Europe, unless I'm wrong, like compared to it was like 5-10 years ago, it's actually much lower.
So I'm not an expert on Europe. In the US, I think part of the story is that firms fired too many workers during COVID, and they've
if you look, and then there's just less people in the labor market in general.
Yeah, and also people stayed home thanks to the government, and they realized that, I mean, you know, they enjoyed it. So their reservation wage, the minimum wage they require to work, has gone up. So yeah, in my view, if employers are finding workers willing to work for what wages they are offering at the moment, they'll take them. So we shall see. But I expect another big surprise. Yeah.
Okay. Outside, I mean, it looks like a lot of stuff this week. Yeah. What else? What are the other key ones?
So the other one I'll be looking at very closely is, of course, personal income and spending, because, as I said, the savings rate is really key in my story. And in that data release, there is a data point that people are not paying attention to, but actually turning points in that data point are really good predictors of inflation and expansion. And it's a real household income without government transfers. And I think it's troughing. And so I'll be looking for a further increase year on year. And that if I see it, it will give me even more confidence in my economic view. Obviously, if this is not the case or things don't work my way, I will let everyone know. But as I said, I cannot change my view because of the price action or because of the...
And you've been right. Yeah, I mean, but even personal spending, I'm saying, you know, if it comes in, the market's expecting 0.8%. It's pretty high.
It's very high. Yeah, I agree. So I'm again, I don't find, and by the way, last week we said exactly the same thing about retail sales. You know, I made the comment that if the economy is tanking, that's not what the concern, that's not consistent.
And the market somehow shrugged it off. Yeah, I remember, you're right, we had this discussion and I was asking you, yeah.
And retail sales turned out even higher than consensus. So, so again, I don't think I will help people much if I change my view because of price action or because of the consensus. I would say one of the blessings of living in Los Angeles is that I'm outside of the New York consensus. I mean, I can get a whiff of it on Bloomberg or Twitter.
Yeah.
But well, besides, so very
Yeah.
nice things like the warm weather.
What
So
about PCE?
yeah,
Is that also a key thing? I've heard you talk about it in the past. And
so PC, there is very little mystery there. We have the Cleveland Fed nowcast for PC, 30 basis point core month on month, which is also what's priced in. I think now everybody is going to look at the Cleveland Fed. No, but if you look at the following month, it's going back into the 0.5 range.
yeah.
So again, I mean, I will change my mind.
No, yeah. But
Justifies it.
I think the biggest thing is just because the market's ignoring any strong prints, you're going to follow the data, and the market, until the data changes, the market's just noise. But there's a lot of data coming out this week, and that investors really need to be kind of aware of all these key data points coming out, and you're going to be there, as you always are, for our clients, and being totally honest and transparent about reinforcing my view, a little bit of a concern, kind of everything around that, as you always are. And as we have a lot of feisty clients who like to push, I think they all really respect the fact that forget about the price action. This is, if you look at the data, this is what it's saying. And I think that's what clients really love. And so do we, obviously. So
I'm glad. No, but seriously, I would have, I mean, I think this is my value added, right? Maybe the market and the data is going to turn and prove the market right. Who knows? Yeah. But the data is what I deal with. And that's why I think I can.
And that's really what's driven your call and has continued to be clearly ahead of consensus, and the consensus is continuing to move towards that call. Anything else investors should be thinking about, or?
No, I mean, we have a little bit of a government funding crisis popping up on the horizon. Government funding expires on the 16th of December, but we are going to go through the usual theatrics, and in the end, it will all get sorted out. The interesting issue is, the more interesting issue is whether the Democrat will raise the debt ceiling before the end of the year, which they can do much more easily than next year.
They can do by like all 50.
Yeah, using reconciliation. Yeah. But I suspect in terms of legislative work, there's not going much that gets done until the Georgia runoff on December 6th, so next week. So no, not much.
Okay, so then I'll do a quick transition or summary, which I was looking at before. For kind of our free Prime users, there were some super interesting articles we put out this week. One key, this is for all our clients. A nice little piece you did is what around the questions I always seem to ask you every week. Why only a recession can kill inflation? If people want even further, as I like, a lot of us like to kind of read and really see the numbers. You yourself wrote an awesome article on that, which all the clients should check out. And again, if you are a free member or you're just listening to this for the first time, please sign up for Prime. And if you have interest for a professional product, you can just email me, or obviously if you're on Bloomberg, just ping me on Bloomberg. The Prime trade ideas, which was great and super interesting call by Bert, who's been very bearish on China, especially on the currency, I would say for pretty much this entire year, has actually turned bullish and believes that this is not a short-term thing. I mean, obviously China is struggling in this reopening, but there is a real commitment to try and reopen and deal with some of these issues, and even potentially try and engage with the US and obviously Europe, definitely more than they have been. Another great thing, I was just listening to the podcast on because there's a train strike here. We had to take a taxi or a car back from the countryside, and I was listening to Bilal's podcast with Fred Thiel from Marathon Digital, the Bitcoin miner, which I have to say was probably one of the top 3 or 4 podcasts that we've done. That was a pretty awesome one, pretty impressive guy, talking, and I think pretty fairly, which you pretty much never or very rarely get in the crypto. You get very extreme views often. He seemed pretty balanced. On the professional side, some awesome stuff this week, especially a few things to highlight. We're continuing to kind of build out, a lot led by Ben Ford, on building out our focus on Scandies as an example. Some interesting views on Riksbank and Norges. Riksbank, where they're continuing to hike rates, but have seen a pretty big pullback in the housing market, which is interesting that the central bank's not letting up. Caroline wrote a really interesting article and analysis of Thailand, where they're continuing to open up and benefit from, well, they would definitely be benefiting from Chinese being able to travel more. And that's kind of an interesting one. And then again, as we've been highlighting and continue to highlight a lot of the work we do on the model-based analysis that we're doing. And by the way, we're most likely, certainly for our professional clients, in the next few weeks, we'll do a webinar really kind of breaking down all the quant work we've done, machine learning work we've been doing, that's out in front and also kind of behind the scenes over the last kind of 6 months. But one of the cool things I looked at was actually that several of the kind of momentum models are turning bullish on the S&P. And obviously there's a lot of different views going into the end of the year. The biggest thing I would just say is we always like to say thank you so much. Oh, Dominique, of course, thank you, for always putting up my timing changes at times. And thank you to all our customers. We know that, we don't take it lightly. You guys, everyone's support, everyone's great feedback, everyone's commitment in many ways kind of helping us continue to build MacRive into the #1 kind of independent source for financial analysis and research. And we just want to say thank you, as we always do. I don't know, Dominique, any parting thoughts?
No, I love the questions. I love the criticism. People who don't take my views, at face value and ask tough questions. This is what helps me improve the quality of my work. So keep it coming. It's really very helpful.
Great. Oh, last thing is, please don't keep MacRive a secret. If you feel like you need to, please feel free to share with your friends and other colleagues as well. So thank you very much, Dominique. Thank you as always.
Hi.
And enjoy the rest of the weekend.